Welcome, Kathy and Jimmy. Today we're going to be talking about the new fund that Ashburton is launching. But first, why don't you tell me a little bit about yourselves and your career so far?
Thanks, Jackie. I'm James Cook. I'm the Director of Investments at Ashburton here and Head of Global Equity. My investment career began at a company called Edinburgh Partners, where at peak we were running 12 billion of global assets together under the mentorship of Sandy Nairn. I left Edinburgh Partners and worked at SVM also in Edinburgh for 7 years. And then really the family got a bit cold living in Scotland, and we decided to move to the sunny island of Jersey because my wife was offered a role here. On moving here, I helped a sell-side bank for a little while and joined a really great investment consultancy here, and then was poached to join Ashburton by a former client, and originally joined here to be head of global equity research. That was coming up to 4 years ago. So we run active global equity strategies here together with Kathy.
Yes, so I work as an investment manager on Ashburton's global equity strategies. I've actually been with the group for coming on 10 years. I started out working on Ashburton's Africa Opportunities Fund. And then, coming on about 4 years ago, I joined the global team. Previously to Ashburton, I was actually a sell-side analyst. I started my career at Bear Stearns in the UK, covering pan-European consumers. And my last role on the sell side was for Barclays Africa, covering the JSE-listed retailers.
Fantastic. And what about support from the rest of Ashburton?
Ashburton is part of First Rand, Africa's biggest bank, and it's really great. We do get a lot of support outside of our core investment team from global macro economists, for instance. So that, there's a lot of help there on the macro, sort of the top-down front. And then we also have support from the local South African equity team who look at companies that are listed in South Africa. So there's often global companies that are listed on the local exchange, and we can share ideas with them as well.
Now we know a little bit about you, let's chat about the structure of the new fund and its characteristics.
Brilliant. Yes, so we've launched the new fund under the UCITS regime. This is a European Union collective scheme. The domicile of the fund is in Luxembourg. Custodian is State Street.
Fantastic. But this is a brand new fund with no track record.
Well, yes, it is a new fund, but we have actually run the global equity strategy for quite a while now for our clients. And so what's great about it is we have a really good 5-year track record against not only the benchmark, but also our peers. So it's a great place for us to be starting.
And how has this performance been achieved?
You can slice and dice performance in lots of different ways. So you can look against sectors, against geographies, and against market capitalisation. And what's really pleasing for us is that it's the stock selection that has driven performance. So that's us managing to choose companies that shares perform particularly well. There's always often a few companies that provide outsized returns, which normally drives portfolio performance, but also actually the market performance as well. And picking some of those really big winners has been a big driver of return. So an example would be Vermilion Energy. So that was a company that I think was trading on a high price to earnings multiple, but actually the cash flow being generated was very, very large indeed, and was I think the earnings were understated because of depreciation of intangibles. And that's something where we made really great returns on. And then there's a few other examples.
Yeah, I think actually an interesting one is a company called Axon. It's a US company, and they sell tasers and body cameras. So their main client is law enforcement, but they've really been expanding their client base or their addressable market by taking on the other federal agencies such as the Drug Enforcement Unit and Border Security. And then also they're starting to go internationally, so they're starting to arm international police forces with tasers and body cameras. But really, I think in terms of what they offer, it's not just the product. They are great in terms of technology. They have a software system that backs this up. Again, another company that actually trades on quite a high multiple, but yet the growth that we've seen coming from this company, and especially through what was quite a difficult year last year economically, they've just continued to grow. So for us, that justifies the price that we're willing to pay for these companies.
You also run the Global Leaders Fund. So what are the similarities or differences to this new fund?
Okay, so I would say the similarities in the companies that we invest in is they're generally quality companies. They have returns that are above their cost of capital. They have strong balance sheets. We like to see them treating shareholders well and fairly. And we want to know that they have sustainable practices in general. I would say a big difference would be the fact that Global Leaders is, we invest in mega capitalisation stocks there, whereas for the Equity Growth Fund, we can actually go anywhere down the market cap spectrum. So really the focus for equity growth is growth. And we are happy to pay higher multiples as long as we believe that these companies can achieve that.
So how much is top down and bottom up? Surely these clash sometimes.
Yeah, absolutely right. So we get brilliant guidance from the top down, information about what's going on in different economies and within different sectors and within different countries. But you're totally right. They can sometimes clash with the way in which we analyse companies from a bottom up perspective. And a good example of a big recent clash would be the consumer discretionary sector. So top down would say the consumer is under enormous amounts of pressure. We've got very high levels of inflation. People are being squeezed. Household budgets are being squeezed. Costs of mortgage payments are going to be going up. A consumer looks like it is retrenching. And yet, from a bottom-up perspective, we continue to find lots of really interesting ideas in that sector where we think that the market has more than priced in the negativity around. And then there are some sub-sectors within consumer discretionary that are not impacted nearly so much by this squeeze on the consumer. So, for example, the luxury goods sector is... we think the consumers of luxury goods, we think, are much more insulated from inflationary pressures. And then also the travel and leisure sector, we're seeing a huge rebound in earnings from those companies, and we've found that as a good source of decent ideas.
Could you give me an example of a recent purchase that you've made?
Yes, so one of our recent purchases is a company called Patterson. It's a US company and it's an oil services company. The reason why we like this company is it fits very well into a sector where we believe the fundamentals are very strong at the moment. So this is the oil and gas sector, which actually a few years ago was really battling, especially over the COVID period. But what we've seen since then is we've seen oil demand pick up quite considerably. Global inventory levels have been run down quite considerably too. We've had the Russia-Ukraine war, and all of this has added to what's been a very supportive oil price environment. How does that benefit an oil services company? Well, the more that oil and gas companies spend on trying to produce more, this leads to revenue growth for oil services companies as the oil and gas companies demand more of the equipment. And also not only the revenue growth, but pricing becomes more attractive because the equipment capacity tightens quite a bit. Patterson in particular feeds very well into the theme, and the reason being is they have quite a big oil rig fleet, and their fleet is high quality. And we have already seen in 2022 their contracts repricing quite considerably. And this has led to really great profit growth, but we still believe there's more. We think 2023 is going to be another great year for these companies. So very excited there.
And how do you generate investment ideas?
So we have a whole array of different ways in which we generate ideas. In the end, we care that it's a great idea, not exactly where it came from. So we have a whole lot of systematic screening, so proprietary screening to Ashburton, and some standard tools, so things that Graham and Dodd helped develop. and that generates lists of companies for us to spend time looking through, and generally it's the companies coming into those screens rather than the static companies that are of interest. We also generate ideas through meeting companies, be that at conferences or when they're visiting Jersey, and meeting a particular company gives you an insight into that company, but also competitors, suppliers, peers, and just general insight into industry. And I don't think we've ever had a meeting, I don't think any of the teams ever had a meeting they haven't thought is worthwhile. And then we come up with ideas on a thematic basis too, so really encourage the team to do a lot of reading generally and come up with interesting ideas. We have connections to the sell side, investment bank research, and they occasionally provide ideas of interest to us. But it's really up to the team to then take those ideas forwards. Once we've generated those initial ideas, we really try and encourage analysts to stop researching those ideas relatively quickly, so to kill the idea early if we don't think that it's worth going any further forwards. So classic examples of that would be a company coming through equity screening might be because there's been a stock split and the data is actually wrong. Once that idea is worthy of further research, then the analysts will spend the time to build their own model, go through the historic information that company's produced, so all the 10Ks of annual reports, 8Ks updates, investor relations presentations, and as much industry data as they think is necessary, try and find what the key drivers are to that company, come up with a forecast of that firm, produce a report, detailed report, which we'll bring to our investment equity group to talk through. Usually during that period of analysis, the analyst will have spoken to the company management or at least investor relations. Some of these larger companies would generally be speaking to investor relations, smaller ones typically the CEOs or CFOs, chief executives or chief financial officers, so that we understand what the key earnings drivers are and to understand critically what's been embedded into the share prices of those companies already. What we're looking for is when the market has underestimated the longevity of the growth prospects of that company, or thinks that there's a near-term dip, or there's got to be some reason that the shares are too cheap for us, and we think that they're going to be good investments in the longer term. After that, the companies will go onto our approved list, and then really it's up to Kathy and I to decide whether or not to include them in our different equity strategies and how much to weight them, which together with some input from the top-down macro team, and of course that can clash a little, we'll come up with the structure of the fund.
And why do you generally sell positions?
So there's three reasons why we would sell positions. So one is when we've got something wrong and we recognise that we've got something wrong, so the investment case changes and we decide we need to sell. Two is when we have a better idea somewhere else and think that we're going to use that, we want to recirculate those funds into a better idea. And three is when we've reached a target price and don't see any more upside.
We all know that sustainability is becoming more important. What ESG considerations do you make?
When we look at ESG, we look at it from a quality perspective. I think for us, we don't believe that a company can continue to earn a return greater than the cost of capital and keep its competitive advantage if it doesn't have sustainable practices. When it comes to governance, we want to make sure again that shareholders are treated fairly. We want to know that when we meet with management and the companies we speak to, that they are taking ESG seriously, there's a focus there. And I mean, I think in general, we wouldn't say that we're ESG experts, but we certainly embed ESG within our research process. And I think certainly if a company had very poor practices, that would potentially derail an investment case for us.
And is this a good time to be investing?
Well, it's certainly an interesting time at the moment because the macroeconomic environment is very poor. I mean, in general, equity investing is long-term in nature, but often at times where you have a cyclical downturn that we're experiencing at the moment, we have the opportunity to find really great companies that have been sold off, and so we can get them at really good prices. So I think it's a very exciting time for us to be launching now.
And Jimmy, have you got any final thoughts?
Well, I think you've heard bits about our people, philosophy, process and performance. We really happy to speak to anybody who's interested.